So you wanna go to war with me? You're talking like you think you're royalty. You think that I'm afraid, but I don't break. I heard you question my stability. You think I'll fall just like a guillotine, but I am here to stay. Won't look away. The storm is coming, so you better start running. No, you can't control, feel it in my bones. I'm coming for the, coming for the. I'm coming for the throne. For the throne. So you wanna be my enemy? You should've known I'd never kiss the rain. Ice runs in my veins, won't play it safe. I don't belong with your nobility. Who died and made you king of anything? You think that I'm insane? It's your mistake. Kingdoms rise and fall. I've come to take it all. I'll take it. I've come to take it. Kingdoms rise and fall. I've come to take it all. So you better start running. No, you can't control, feel it in my bones. I'm coming for the, coming for the. I'm coming for the throne. For the throne.
Go, yo, I'm like an addict, do I gotta have it. I ain't even playing, got a really bad habit. If it moves, gotta grab it, fuse like a magnet. Lose, won't have it till I'm doomed in a casket. I ain't playing, got a weird mind. If you work 8 hours, I'ma work 9. If the shit tastes sour, you should taste mine. I'ma stay in power for a long time. Get up, nah, I ain't a quitter. Toss me the ball, I'm a really big hitter. Big picture, I'm a straight killer. Rising the song to the highest bidder. Got juice, got gas, I'ma move fast. New shoes, new tracks, like who's that? I'm new, come back, better than last. Yeah, it's a new me, never gonna look back. Never gonna look back. Cause damn, I was built to last. You move slow and I move fast, and that's facts. Only I can make a change. Slowly take a step today. I will never be the same. Cause that's what it takes.
Pushing till I fall, I'm slipping to get back up. Always stand tall, I'm grinning. All right, y'all, good morning. It is, what is today? February 18th. We have the Cinemark earnings call getting ready to start any second. I'm going to unmute the sound and see if they hear anything. I don't hear music either, though. The Q4 for the industry was a little bit lighter compared to last year. Cinemark's Q4 results were slightly down year over year.
Also, today's call will include
we do have them
a reconciliation
live
of these
now, so
non-GAAP
let's get that back on
to
the
the most directly comparable GAAP financial measures can be found in the website's most recently filed earnings release, 10K, and on the company's website at ir.cinemark.com. Joining me this morning are Sean Gamble, President and CEO, and Melissa Thomas, CFO. Beginning with today's call, we are shifting our earnings format to provide adequate time for your questions. Following brief introductory remarks from Sean, we will open up the lines for Q&A. With that, I'll turn the call over to Sean.
Thank you, Chanda, and good morning, everyone. Before we dive into Q&A, I'd like to briefly reflect on our 2025 results, as well as the advancements we've made over the past few years. Driven by further market share expansion and a series of all-time record achievements in 2025, we delivered a post-pandemic high in worldwide revenue of $3.1 billion. This strong top-line result, combined with effective cost management and incremental productivity gains, resulted in $578 million of adjusted EBITDA, with a healthy 18.6% adjusted EBITDA margin. Through a relentless focus on initiatives that are aimed at expanding our audiences, activating new sources of revenue growth, optimizing our circuit, and continuously improving our processes and capabilities, we have taken the experiences we create for our guests and our operating agility to new levels. Furthermore, we have developed a distinctive set of competitive advantages, including a differentiated position of strength. Over the past 3 years, we generated nearly $1.8 billion of adjusted EBITDA with over $1.3 billion of operating cash flow. We increased customer loyalty to Cinemark, meaningfully expanded our market share, and grew our concession revenues and per caps to all-time highs. We refortified our balance sheet, extinguishing over $700 million of COVID-related debt, while at the same time reinvesting over $500 million in capital expenditures to advance our company for the future, and returning $315 million to shareholders through dividends and share buybacks. Achieving these results has required extraordinary dedication, ingenuity, and perseverance throughout our entire company, and I'd like to commend our sensational global team for the significant impact they have made, setting up Cinemark for ongoing success in the current environment and beyond. As we look ahead, we remain focused on effectively navigating an evolving media and entertainment landscape, continuing to diligently operate our business and delight our guests week after week, and effectuating a multitude of strategic initiatives to further strengthen our company and market position. 2026 appears set to benefit from a robust lineup of compelling films and a volume of wide releases that looks poised to reach pre-pandemic levels. We are excited about the prospects of this year's slate, and we remain highly encouraged by sustained consumer enthusiasm we continue to see for the types of larger-than-life cinematic entertainment we provide at Cinemark, as well as the multitude of opportunities before us that are fully within our control to create incremental value for our customers, partners, and shareholders. Operator, we'd now like to open up the line for questions.
Thank you. The floor is now open for questions. If you would like to ask a question, please press star 1 on your telephone keypad at this
Wow,
time.
right into
A
questions.
confirmation tone will indicate that your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. Again, that's star 1 to register a question at this time. Our first question is coming from Eric Handler of Roth MKM. Please go ahead.
Yes, good morning. Thank you for the question. Sean, given how well premium has been performing for you guys, I'm curious, how many of your theaters have two XD screens? Are there plans to add more theaters with multiple XD screens? And what do you think ultimately that could be?
Sure. Thanks for the question, Eric. Definitely, premium amenities, we're seeing a growing interest from a section of our audiences who really enjoy the added enhancement that they provide. Specific to your question, we've got about 10% of our domestic circuit that has two XDs. There are others that have, a combination of an IMAX and XD, a Screen X and an XD, but that's where the overlap. Part of the governor on that is just having enough significant screens to add an extra XD to. We're very particular about making sure that if we're selling an enhanced experience, that it fully delivers on that, and that's beyond just the sound, the environment. It goes to the scale of the screen. So if it's an existing theater, there needs to be a second auditorium that can do that. We are in the process of rolling out additional screens over the next few years, so we're going to be continuing to do that. So we've got still a nice runway of opportunity, but I'm just flagging that there are some limits to how it. We also are just focused on how many of those we have in a theater. Premium enhanced formats still only represent about 15% of overall box office. So while there is a group of moviegoers who do like to pay that additional enhanced experience, the bulk of moviegoing still is on all the other screens, and our focus is continuing to make sure all of our screens are a premium experience, regardless of whether you choose XD or something else.
That's helpful. And then I wonder if you have any type of updates on new build activity, be it in the U.S. or Latin America.
Sure. Our new build pipeline was slowed during the pandemic, obviously, and then we've reactivated our real estate efforts in exploring opportunities out there. We've got a number of things that are in motion, but these projects can take 2 to 3 years to get off the ground. So we opened a new site in El Paso in 2025. We've got plans to open an additional site in Greenville, Texas in 2026. We've broken ground in Omaha, Nebraska on another site for 2027, and then we've got a range of other projects, as I mentioned, that are in motion. So we've reactivated that. It just takes a little bit of time to fully get up to speed because you got to make sure you get the right site, and when you go through all the exercise of finding the locations, negotiating the deals, working through all the regulatory processes, it can just take a little bit.
And Eric, you see that increase in our pipeline coming through as well in the step up in capital expenditures that we're expecting from 25 to 2026. So that is reflected there, as well as, to your point, on XDs and how many opportunities there, expansion in XD, ScreenX, and D-Box as well.
Thank you very much.
Thanks, Eric.
Thank you. Our next question is coming from David Karnovsky of JP Morgan. Please go ahead.
Hey, thanks. Sean, in your executive commentary, you noted the softer than anticipated slate last year. So I wanted to see, just with some hindsight, you could walk through the factors that you think drove this. Is this primarily about quality and film mix, or are there any kind of structural impacts to consider, like windows? Thanks.
Sure. Thanks for the question, David. At a high level, I would say we view it more as just the normal ebb and flow of the industry. I think perhaps some of the expectations for 2025 got a little bit overinflated coming in. We had some pretty lofty targets for select films. When we look at the aggregate of the aggregate slate, there was a bit more of a mixed bag of the ones that overperformed and some of those that didn't fully resonate. The year lacked a mega blockbuster that exceeded $500 million, and there really was no major summer animated film. So I think if we had one $300 million animated film this summer, which we traditionally do, I think everybody would be viewing 2025 much differently. So I think I don't view that as a real structural issue. I think it's just more the way sometimes the strength and quality of films play out and how well they resonate with audiences. Windows is something we do continue to evaluate. It's something, it's a big topic for the industry. There are indications that awareness of highly shortened windows is having some effect on smaller movies and more casual moviegoers, which could be providing some headwinds to overall recovery in the industry. So there is a factor, but I don't look at kind of the softness versus expectations on 25 necessarily because of that. It's just more based on some of the really high expectations we had.
Okay, and then just with margins, when we look at 25, obviously attendance was a headwind, but assuming a recovery this year, how should investors think about room for operating leverage? And Melissa, any help in thinking about kind of cost of goods, staffing, or G&A? Thank you.
Sure. From a margin standpoint, we would expect, given we do expect a stronger box office and higher attendance year over year, that would support leverage in our operating model as well as margin expansion. As you know, our EBITDA margins are most heavily influenced by those two factors of box office and attendance. That said, there are a number of variables beyond that influence our margin. There's market share, average ticket prices, and food and beverage per caps. And then in addition to that, incremental value that we expect to capture from our strategic initiatives and our ability to manage cost pressures. And then for international segments, our performance will depend on, we're talking about film slate, so how film slate resonates with their audiences, as well as inflationary and FX dynamics. And then to your question on expenses, particularly on a go-forward basis, from a G&A perspective, we do expect our G&A to continue to reflect merit increases and rising benefits costs. We are making targeted strategic investments in talent and capabilities, including cloud-based software, to continue to advance our strategic priorities and position the company for long-term success. But we remain disciplined in our approach to expense management, ensuring that our spend is closely aligned with long-term objectives. And then broadly, as you think about our variable costs, those are going to flex with attendance, albeit not at the same rate.
Thank you.
Thanks, David.
Thank you. The next question is coming from Eric Wold of Texas Capital Securities. Please go ahead.
Thanks. Good morning. I guess a question on kind of a moviegoer monetization. Can you talk about with the strength you had in concessions, Q4 and then broadly throughout last year, what strategies have been driving the most success that you've kind of put into place, with the various ones that you've used? Any way to parse out how much of the increase was, film mix influence versus, just basket and incidents? And then lastly, kind of, what do you think the opportunity is going to push ticket prices and concessions higher this year, given the environment that we're in economically? Thanks.
I'll take that one. From a per cap standpoint, our per caps domestically were up about 5% year over year. And there are three primary drivers to that. First, our strategic pricing actions. Second, higher incidence rates. And then third, a shift in product mix, given the growth in merchandise sales as well as enhanced foods. As you think about kind of the breakout that I'd call it probably about around 3 points strategic pricing, a point incidence, and a point driven by shift in product mix. In terms of the key catalysts, as we've said before, food and beverage, and this is a game of singles and doubles, we have a variety of initiatives that we've been executing upon and others that we will be executing on to really drive growth on an ongoing basis. And that includes increasing the throughput of our concession stands, leveraging planograms to improve the monetization of our space. We continue to introduce new concepts, new flavors, expanding our enhanced food offerings. We still think there's runway there, as well as growth in movie-themed merchandise, and that's just to name a few. As we think about the go forward, looking ahead to 2026, we do remain optimistic about our ability to deliver another year of moderate year-over-year growth in concession per cap, supported by the broad range of initiatives that I just mentioned. And we do think that growth can come from both incidents as well as further opportunities to optimize our pricing. Bear in mind, from quarter to quarter, our per caps will fluctuate with film mix. And then in our international markets, we do expect concession per cap to be impacted by inflationary as well as FX dynamics in the region, while shifts in country mix also can play a factor. Overarchingly, our focus is on delivering sustainable per cap growth and ensuring that our strategies are supporting both profitability and long-term value creation.
Perfect. Thanks, Melissa.
Thank you.
Thank you. The next question is coming from Chad Benyon of Macquarie Asset Management. Please go ahead.
Hi, good morning, Sean and Melissa. Thanks for taking my question. Wanted to ask about international attendance. It fell in 25, and I believe a lot of that decline was really just kind of a product of what was out there in terms of the movie slate. But as you look at 26, Sean, I know you talked about your optimism, maybe domestically or globally. But what about internationally? Do you think this could be an inflection point, and maybe we could see attendance even exceed what we're expecting in the U.S. in 26? Thanks.
Sure. Thanks for the question, Chad. Yeah, I mean, I think you're right. When we look at overall 2025 for Latin America in particular, the profile of the slate in terms of what worked and kind of what didn't work, it skewed a little bit lower for that region relative to the U.S. When we look at it, so that's just nothing more than the product, and we see how that kind of can fluctuate year to year. 2026, specific to that region, we are optimistic about a better balance relative to the U.S. We think that the overall slate looks set to resonate stronger with Latin audiences than 2025 did. So you got titles like Michael, the Super Mario Galaxy, Spider-Man, Brand New Day, Minions, Avengers, Doomsday. These are all movies that really will resonate. There's another Insidious title in that particular type of genre of horror, and that franchise in particular has done really well there. Certain films like The Odyssey, Star Wars, Supergirl, Cat in Hat, like some of those, like sci-fi oriented Dune, those do tend to skew down. But on the whole, we definitely are more optimistic about 2026 in LATAM. And, in general, attendance throughout that region has recovered, in certain pockets more so than in the U.S. With everything, I mean, great example we always like to point to is Argentina. With all the hyperinflation and the economic and political turmoil that has happened within that country over recent years, attendance is neck and neck with pre-pandemic levels. So they've recovered exceptionally well. So when the content is there and it connects, that region in particular can really show some upside.
Okay, great. Thank you. And then as we think more broadly, just in terms of the loyalty product, I think you said 60% domestically, 30% internationally. Are there any changes that we should expect in the near term that could either help that loyalty, increase movie going? Just anything on the product side that could be different in the near term for consumers. Thank you.
I would say I don't know if there's anything materially different. I mean, I think that the core value and the core benefits that are inherent to these programs continue to resonate with existing members and continue to attract growth in our overall membership. Like, we've continued to see growth year after year in these programs. Movie Club in particular in the U.S. is up over 50% from where we were in 2019. We do expect that will start to level off a bit more as the program continues to mature. But thus far, we've continued to see terrific growth. So what we're doing is In addition to those kind of core benefits, we do keep adding additional elements to it just to keep it fresh and enrich it. There's all kinds of surprise and delight type of events we do for our loyalty members throughout the year where they get invited to special programming and things of that sort. I mentioned that we just added a new premium tier to Movie Club, which we're hopeful will attract those audiences who are more inclined to upgrade on a regular basis. We've introduced badges. So there's a whole slew of things like that we continue to add to the program to make it attractive from a retention standpoint, as well as attracting new guests. So I think that's really it. We do other kind of promotional events, sometimes tied to films, sometimes tied to just engaging types of incentives, also to stimulate growth. But those are the things that we're continuing to lean into to sustain growth and sustain our existing membership.
Okay, thank you very much.
Thanks, Chad.
Thank you. Our next question is coming from Drew Crum of B. Riley Securities. Please go ahead.
Okay, thanks. Hey guys, good morning. So consolidated ATP growth has accelerated over the last few years. How do you foresee the rate of change for ATP trending going forward, given the ongoing shift towards and success with PLFs across your circuit, amongst other factors? Is the mid-single digit increase the business delivered in 2025 a new normal, or was last year more of a one-off and not sustainable?
Thanks for the question, Drew. So we have, to your point, we were pleased. We've delivered a 4% CAGR in our domestic average ticket price over the past 3 years. As we look ahead to 2026, we expect average ticket prices will increase modestly year over year in the full year, and that's really twofold. One, we do believe that there's further strategic pricing opportunities, as well as opportunities related to our continued expansion of premium offerings. So as we mentioned, XD, D-Box, IMAX, and ScreenX. So we do think it's twofold, but not likely, to the same extent that we saw in 2025, given some of the outsized mixed benefits. But keep in mind, average ticket prices, they will fluctuate quarter to quarter, depending upon the film mix. And then on the international side, inflationary and FX dynamics in the region could play a factor, as well as country mix. We do continue to approach our pricing decisions thoughtfully and are leveraging data to identify those optimal price points that maximize attendance as well as box office performance.
Got it. Okay, thanks. And then maybe one follow-up. Can you address the planned splits between U.S. and international in terms of CapEx spend? And is the $250 million number you're planning for this year a good annual run rate for the business, or is 26 a peak? Thanks.
Yeah, so in terms of splits between international and the U.S., I mean, typically around 50 to 60 million of our CapEx is dedicated on the international side. Remainder is towards the U.S. And then in terms of our capital expenditures in 2026, those are ramping up to $250 million, and that's based on not only our expectations for cash flow generation, but also the ROI generating opportunities in front of us that we're looking to pursue. As we look forward beyond 2026, the extent of our spending and whether we kind of stay at that $250 million level will again be predicated on the ROI generating opportunities we see in front of us. And then the other point I would call out is as the new build pipeline ramps, that can cause variability from year to year with temporary upticks and then coming back down, just depending upon where we're at within that new build timeline. So there could be some fluctuations, but we, by and large, I would say we're too early to tell at this stage.
Mm-hmm. Okay, thank you.
Mm-hmm.
Thanks, Drew.
Thank you. The next question is coming from Patrick Scholl of Barrington Research. Please go ahead.
Hi, good morning. I just had a quick
follow up on some of your CapEx comments. Just on the new builds, are these kind of expanding into like additional markets, or are they kind of more replacing older theaters within those markets? And I guess similarly, is that sort of the path that you're taking to increase the recliner penetration, or are you still finding opportunities within existing theaters to kind of renovate those and increase the, I guess, competitiveness and attractiveness of those amenities?
So in terms of the new build pipeline, at most of the locations that we are looking at are new locations. So that would be in new markets where we see that there's under penetration and there's an opportunity for us to go in and have a high confidence return. So that is really the genesis of what we're doing on the new build side.
And I would add on the recliners, we do still see recliner opportunities. I mean, with 72% of our circuit reclined in the U.S., those are fewer than they once were, but we are still finding opportunities beyond our new builds to have attractive returns with some of our theaters that strengthen the overall competitiveness as well as just provide a good lift in performance.
Okay, and then on just the film slate for 2026 and maybe even 2027 as well, I guess, how are you seeing like the cadence of releases, and are you seeing it kind of create more stability in box office in the coming years? Just how are you doing that?
It's a great question. I mean, the good news is volume continues to grow. We saw that 2025 got to within 5% or so of pre-pandemic levels. 2026 looks to at least match that, potentially go beyond that. And the benefit of that is obviously our industry tends to be a bit of a momentum type of business where people come to the theater, they see what's coming up, they get excited, they have a good experience, and they come back because of that. And when you get these kind of lulls in terms of things being released, you're winding up having to reboot the engine over and over and over again. And that's the type of cycle that we've been in. So I think the good news is with further recovery and volume coming forward, there should be fewer of those instances of having to reboot. I will say what we've still yet to see, and these are conversations we continue to have with our studio partners, is for a long while prior to the pandemic, we would see more of the films getting bunched in the summer and at year end. And then in time, everybody learned it's a 12-month calendar. Movies can do huge business any time of the year. First quarter, late summer, not just kind of in those peak when kids are off from school types of months. I'd say the industry's gravitated a little bit back to this old norm, and we see a bit of a more crowded summer in 2026 and a crowded year end. So that's one of the things that we're still looking for that to fully resolve itself, so we can truly have a fluid cadence of movies every month throughout the year and just sustain that momentum. So that's something that still is being sorted out, but the good news is it's moving in the right direction.
Okay, thank you.
Thanks, Patrick.
Thank you. The next question is coming from Robert Fishman of MoffettNathanson. Please go ahead.
Good morning. Two for you. When you look at 2026 and beyond, how do you balance leaning into your organic growth led by the sustainability of market share gains compared to positioning the company for other opportunities like M&A that hasn't really been an option for a while? And then just if we could get any update on where things stand with any conversations you've had on the Warner Brothers acquisition, both with either Netflix or Paramount Skydance. Thank you so much.
Thanks, Robert. I'll take the first part of your question. So in terms of our strategy for investing in growth, we have a balanced and disciplined approach to capital allocation, and we intend to invest in growth opportunities, including new builds, existing theater enhancements, and M&A to the extent attractive opportunities present themselves. As you think about M&A, we evaluate all transactions that come to market, and we target high-quality assets with minimal deferred maintenance needs. And consistent with our disciplined approach, we're looking for accretive M&A opportunities at attractive multiples. Prefer to deepen our penetration in markets where we already have a presence to leverage established infrastructure, relationships, and market knowledge to drive growth and create value. Naturally, there's other factors we also look at, so scale, strategic importance, competitive positioning, and margin profile. And then in terms of new builds and theater enhancements, we, again, remain disciplined with our capital expenditures. We're looking for ROI generating opportunities that are high confidence and that position the company well for the long term and enhance the guest experience. But overarchingly, we're looking to balance among the three, but that is something that we're evaluating on an ongoing basis to try to create value for all shareholders.
And on that last point for Warner Bros., I'll just add too, they're not mutually exclusive, right? I mean, we've got the good news is with the strength that we've recovered of our balance sheet, we have the opportunity to pursue multiple attractive, creative types of deals, whether they be new build or M&A to the extent they're there. But as Melissa said, we're going to continue to be disciplined in that approach. Specific to the Warner Brothers deal, I don't know if there's a tremendous amount to update on that. Clearly, the overall transaction remains pretty active and fluid in terms of what direction this may go going forward. Our focus, along with our trade organization, Cinema United, has just been to engage directly with all the respective parties, as well as the regulators, to ultimately pursue an outcome that is in what we believe is in the best interest of our industry, of the creative community, of consumers, and of the local economies that benefit from healthy theaters in their towns. And that's a focus on sustained volume of output with whichever direction this transaction plays out, sustained exclusive theatrical windows in a meaningful way that support the industry, as well as sustained levels of comprehensive marketing campaigns to get that message out. Those are the things that have driven value, have been moving in a positive direction with new entrants coming in and growth from different players in terms of volume. And we just want to make sure that things continue to progress that way versus any type of risk that might ensue from a consolidation of a significant studio like Warner Brothers that has been a strong partner of theatrical exhibition for many, many years and just had a record-breaking performance in 2025.
Sounds good. Thank you, guys.
Thanks, Robert.
Thank you. The next question is coming from Omar Mejias of Wells Fargo. Please go ahead.
Good morning, and thanks for the question. Sean, market share has been a key driver of Cinemark's outperformance, and we were encouraged by the 4Q results despite the softer box office. I understand that the box office continues to recover. There might be some capacity constraints, but how have you guys been able to gain share, and how do you plan to manage your footprint with the busier slate in 26?
Sure. Thanks for the question, Omar. I mean, it's been a variety of things we pursued. I mean, there's if we kind of unpack 2025, first, we were thrilled with our overall results of 2025. We continue to see the benefits of the varied initiatives that we've been pursuing to build our audiences, everything from our showtime, programming, to our marketing actions, to our pricing strategies, to our loyalty programs, which we spoke about earlier. All of those things have helped support increasing our structural market share. 2025 in particular, while we had at the beginning of the year expected our market share might moderate a little bit, it actually continued to benefit from a high concentration of outperforming family and horror films, as well as what played out to be more of a balanced cadence of releases throughout the years, which limited the amount of capacity constraints we hit and enabled us to fully optimize our screens. So we benefited from that throughout the year. I'll flag that obviously our share year to year will fluctuate based on that content mix and how well individual films resonate with our audiences as well as those capacity constraints. So when we look at 2026 in particular, again, we see a highly compelling, diverse profile of films on paper as we look at the composition. There is a little bit more crowding that we do see during the summer and year end, as I alluded to a moment ago. You've got some pretty substantial films in that pocket, which could lead to more capacity constraints where we're just fully utilized and don't have the benefit of kind of expanding further like we were able to do in 25, which could create a little bit of a headwind and cause our market share to normalize a bit. Ultimately, it's just going to depend on how the actual results film by film play out and the extent to which any of those dating decisions spread a bit more from the way they're organized right now.
Great. And on alternative content, you guys have seen some notable success recently. Just curious how Cinemark's leaning into this category and what untapped opportunities do you see within this vertical? Thanks.
Absolutely. Look, I think alternative content is definitely one of the real positive signs we're seeing with nice growth. Similar to younger moviegoers, we're seeing nice growth in younger moviegoers, but specific to alternative content, we've had multiple consecutive years now where alternative programming has been more than 10% of our box office. And that's just not just because of the overall box office. The pure proceeds from alternative content, as an example, in 2025 are up more than double what they were in 2019. So audiences continue to be attracted by this content, and it's a range of different areas, everything from faith-based films to anime to other foreign films, content creator, concerts. There's a whole slew of things that are repertory films. I mean, they just continue to grow in their scale and magnitude. And your specific question on what are we doing, I mean, we have a team that is dedicated to finding these kind of opportunities, pursuing them, and then trying to really understand what the potential is so we can optimize how we're programming that throughout our circuit. And it's been really successful, and we expect, or at least we're optimistic about continued growth in this area as we move forward.
Great. Thank you, guys.
Thank you.
Thank you. Our next question is coming from Mike Hickey of StoneX. Please go ahead.
Hey, Sean, Melissa, Shanda. Congrats, guys, on a 25, and I appreciate this new format as well. It's very helpful. First question from us is just, Sean, the impact on AI. We've obviously seen AI sort of, pun intended, rewrite the script here of a lot of companies. And being, I guess, destructive here, but it seems like out-of-home entertainment is in a really sweet spot in terms of not being negatively impacted. And I guess the flip side, the positive impact, although delicate, I'm sure, but on film development, it seems like there's a lot of opportunity to reduce expense and time and ultimately increase volume. So I'm just sort of curious overall your view on AI and how helpful it can be to your business, and I have a follow-up.
Sure. Well, you captured some of the points nicely there, Mike, and I'd say broadly, we're optimistic and enthused about the potential AI has in a number of areas. I mean, specific in terms of things we're doing within our company, the ability to both drive efficiencies as well as support our revenue growth objectives. We see lots of opportunity. We're already incorporating it into pricing optimization, some of the showtime optimization efforts I mentioned, our app development work in terms of how we're doing our software development. We've even got it going in our hiring activities within HR and our guest services. So there's a whole range of things that we're looking to utilize this for within our own company. And then on the content creation side of things, as you just mentioned, we see lots of potential for AI to unlock new types of capabilities, whether that's in visual effects, previs, and efficiencies just in terms of movie making with timelines and things of that sort, which could lead to an increased volume of movies being made as well as just new quality enhancements along the way. So we see a lot of potential for that. Just as every filmmaker has his or her own unique way of bringing stories to life, it would appear that AI is another tool that can enable select filmmakers to use it effectively and do new things that we haven't seen before. Obviously, there's quite a bit of risk regarding IP and copyright right infringement, and we very much support filmmakers and creatives and our studio partners in their efforts to protect their IP with AI as it evolves. But it seems like if that balance can be struck appropriately and the right measures and safeguards are in place, there's just a tremendous amount of potential that AI provides for our business specifically and broadly for the industry.
Nice. Thanks, Sean. The next question on the Warner Brothers deal, and I guess specifically focusing on Netflix here. Definitely not asking you to bless anything, but just sort of holistically, just sort of your view on a couple things. One, Netflix was originally thinking of a 17-day window, and I think they shocked and awed a few of us here and went to 45-day window, and maybe that's in front of streaming, so that's a consideration. But just thinking about a new partner here with a 45-day window, how you think, whether that's workable or not. And then I guess just to maybe your own view, Sean, in terms of Netflix, if they're being sincere, or maybe if you believe, obviously you've had conversations with them, they've been ongoing, just as part of your business, if you believe they can be a real theatrical partner for you, not just the Warner Brothers asset, but maybe the core asset as well. Thank you.
Sure. Thanks, Mike. Look, I'd say we've said this before for a long while. We've been optimistic that in time, Netflix would recognize the opportunity that theatrical exhibition provides their platform and their content, much like all their other peers are doing, whether it's traditional studios, Amazon, even Apple getting a bit into the space. We've seen through data and we've heard from the conversations that theatrical exhibition provides a real meaningful lift to engagement and retention and interest in those platforms. So we thought for a long while there's just value that was being ignored by not taking advantage of that opportunity. We're obviously, look at the recent comments providing some element of encouragement. I would say that we, much like our industry at large, is a bit apprehensive in just placing too much stock into those comments, just given how contradictory they now are to many of the other disparaging remarks that have been made over the recent years, even as recently as middle of last year when there was references to the industry being outmoded as an idea. So I think there's going to need to be more action versus comments to really, and firmer assurances to give everybody comfort that what's being said is real. 45-day window, I think generally speaking, we all view that as a good target point that strikes the right balance of giving studios more flexibility with getting content into the home and capitalizing on the market campaigns that have been spent in the theatrical space without creating too much adverse risk to theatrical performance. As I mentioned earlier, in some cases, things have kind of overshot that a bit, and it's causing some concern about what that might mean on select films. So it's a good starting point, but it also begs the question of 45 days to what? Like 45 days to a transactional type of offering in-home, like a premium video on demand is one thing where there's a price point there. 45-day window to an SVOD, which consumers generally view as free, is a different type of construct. So there's a lot still to clarify with what exactly is being referenced. And again, I think we're all looking for much firmer assurances that are long-standing for not only a window, but levels of continued investment and also sustained marketing, which is a critical component of this too, versus just verbal comments and promises.
Nice. Thank you, guys.
All right. Thanks, Mike.
Thank you. Our next question is coming from Stephen Laszczyk of Goldman Sachs. Please go ahead.
Hey, great. Thanks for taking the questions. Sean, just would love to get your latest thoughts on what you're expecting to see on the competitive front this year. And if you're seeing anything that as you make your way out of 25 into 26 that might make you more confident that some of the recent gains in market share are perhaps more structural or could become structural with how you position the brand as you look ahead into this next year?
Sure. Well, look, I think from a broad competitive landscape, I think competition just continues to grow. I think we see industry at large improving marketing capabilities, continuing to lean into amenities and upgrades. And I think that's a good thing on the whole because it creates an overall lift for everybody. We too, obviously, are continuing to ratchet up our competitiveness, pursuing ongoing initiatives in all the different areas we've talked about before to try to push our share even further. I think the structural gains we've talked about, we're very pleased about. We do our best to kind of tease out how much is content mix and capacity constraints relative to structural things, but we've said we believe at least 100 basis points, growing beyond that, 100 basis points of our gains since pre-pandemic levels, we believe are sustainable, and we continue to push that further. So I think we feel good about the direction we're heading in, and I think our ability to continue to compete as overall competition grows.
Great, thanks for that. And then, Melissa, maybe just to follow up on margin, curious if there's any more help you could perhaps provide investors just on the magnitude of margin expansion you would expect to see in 2026 if box performed in line with expectations and given some of the puts and takes you called out on the expense side a bit earlier. Thank you.
Yeah, so from a margin perspective, again, as I mentioned earlier, really box office and attendance are going to be the primary drivers. And given anticipated growth, we do believe that supports margin expansion. But there are a number of other variables at play. We've talked about on the average ticket price side and per cap side that we do expect to continue to grow those top line measures. We talked about market share a bit. We'll have to see how the film slate, how individual films shake out to see where market share trends. And then from a big picture expense standpoint, as I was alluding to earlier, so we do expect to gain some leverage over our fixed costs, and that's particularly in the U.S. where we have a higher fixed cost structure. On the variable expense side, film rental and advertising, salary and wages, concession supplies, and then in the case of international, facility lease expense, those will fluctuate based on attendance and box office performance, although not necessarily at the same rate. Other factors from a modeling standpoint to consider would be ongoing inflation impacts on wage rates and certain concession categories. Also, from a film rental standpoint, just keep in mind that that's going to vary depending upon the mix of blockbuster content. And then utilities and other expenses, I would just call out there. We expect them to remain elevated as we continue to address deferred maintenance needs across the circuit, albeit from a year-over-year standpoint, I don't expect that to be a meaningful headwind given that we started those efforts in 2025. Also on utilities and other, just keep in mind electricity costs, which continue to be impacted by rising market rates. Outside of that, we continue, as always, to pursue productivity initiatives and cost mitigation strategies to maximize our profitability and margin potential.
Great. Thank you both.
Thanks, Steven.
Thank you. At this time, I'd like to turn the floor back over to Mr. Gamble for closing comments.
Okay, thank you, Donna, for your help, and thank you to everyone for joining us this morning. Really appreciate the time and all your questions, and we look forward to reconnecting in a few months to share and discuss our first quarter 2026 results. Have a great day.
Ladies and gentlemen, this concludes today's event. You may disconnect your
All right. Cinemark trading at 25.50 in pre-market this morning. Not a big move on this morning's news. Let's recap a couple of things. And I'll put out a quick video recapping these results and going through my risk spreadsheet. You guys are familiar with the green, yellow, red, kind of like dashboard, if you will, how we view these in 5 seconds. But Cinemark achieved the highest post-pandemic revenue since COVID, obviously, in 2025, with total revenue for the year $3.1 billion. Their Q4 revenue was down a little bit year over year compared to 2024. Other big things that differentiate them from their competitors, they had a positive net income for the year of $141 million, $578 million of adjusted EBITDA. They did share repurchases and they pay a dividend, so $315 million was returned to shareholders through both dividends and share repurchases in 2025. And they have a pretty, I'd say, if I'm comparing it to a AMC, a pretty hefty spend on CapEx to maintain and enhance their circuit. $219 million for 2025. What Cinemark, half the size of AMC. They're spending as much on maintenance and upgrades as AMC is. I know we get, when we look at AMC, I think they're spending like drunken sailors. Not really. Cinemark is spending as much as AMC on maintenance and upgrades because they can. They have the free money to do it. I still think that AMC would want to spend more if they could, but they got to keep their CapEx spending in control. A couple of things that I highlighted here. Just in closing, total revenue, as I said, was down compared to 2024, about 4%, Cinemark. But on the annual basis, it was up 3.1 billion versus 3.5. Positive net income down compared to 2024 basis, but positive net income less on an annual basis. Cash and cash equivalents, 344 million is where they ended up. I know that might not sound like a lot, but Cinemark has a different debt situation than AMC. Plus, they spent some cash to pay off the balance of their debt in 2025, and they pay dividend, yada, yada, yada. So they don't need to carry 600 or 800 million in cash as long as they have free cash flow coming in. 344 million, plenty adequate for them, and I'm sure they'll build that back up. If we look at their cash balance over time, you could see how it was growing, and then it dropped when they went to go pay off that debt last year. Operating activities cash flow positive by $396 million, and free cash flow on an annual basis positive $177 million. And when we look at AMC here in a week, I want you to pay attention to what the annual free cash flow is going to be. A negative number. Now, everybody is going to want to talk about Q2 through Q4 was positive. Yes, that will be true for AMC. But the market, guys, is looking at annual free cash flow. And when AMC is losing $400 million in Q1, like they did, you're not going to have $400 million to offset it in Q4. So don't be distracted by people trying to focus you on Q2, Q4. It's cool to say the last 3 quarters are positive free cash flow, but it's also kind of tricking yourself if you ignore Q1. Don't let people do that to you. Look at it on an annual basis. Sales were down a little bit. We mentioned both in the U.S. and international segments for Cinemark. International for Cinemark means Latin America versus something like an AMC where international means Europe. Neither one of them have any Asia footprint. That would be IMAX that has the Asia footprint. And we'll be covering the IMAX call coming up. They're already scheduled on my channel, IMAX, Marcus Corp, MCS, and AMC, all scheduled. So I hope to see you guys on those calls. See if you have any last minute. Mike says Cinemark owns a lot more AMC leases. Thank you for that, Mike. I will, when I do my wrap-up video, I'll compare that, because some people were asking me in the past several weeks, as we were talking about ways to value AMC, they were asking me, doesn't AMC own most of their locations? No, they actually own almost none of their locations. I think it's like, what is it, Mike? AMC owns maybe 33 out of 890 locations. All the rest are leased, which is fine. I mean, it's fine. Doesn't really matter. Oh, same for CapEx. Yeah, send me a message, Mike, and let me know how you think that might play into why Cinemark might be having a higher CapEx. Because, I mean, just like my high-level thought is, it doesn't matter if you're leasing or you own, you're doing upgrades or maintenance. Well, maybe where you're going is on some of these leases, the landlord has maintenance expenses that they cover. I don't know. Depends on the lease. Some leases, as I'm sure you know, they make the tenant responsible for everything. I've leased commercial property, and you just hate to sign a lease where, oh, if the AC goes out, the unit on the roof, the tenant has to replace it. Well, F you, man. You better know about that shit before you sign a lease, ladies and gentlemen. Because what if you're moving into a 10-year-old property and that AC unit's only got a couple years left on it and you're signing a 7-year lease? Ooh, man. You don't want that. So yeah, it does depend on how the leases are set up, and how does that work on a huge property like these movie exhibitor halls? I don't know. It's a good question. If I ever got Sean Goodman or Melissa from Cinemark in a room, I would like to know the answers to that question. I should ask my friend that used to be a controller over at Alamo if she knows the answer to that. I bet we could get to the answer through someone that I know. Anywho, thank you guys. It is 1 minute till market open, so let's get busy. Let's go make some money. I do own some Cinemark, by the way. I trade Cinemark. We sold out in one of these run-ups right here. Have it on the screen. Anyways, I exited the position, I think it was towards the end of 2024, and waited a while for it to come back down. I rebought on December 5th. No, I did not time the bottom perfectly. I got in at 21.76, the low a week or two later, 21.60. So I missed it by 16 cents. I am sorry. But I do have up here, you can see this is my little crazy 12-month price target for Cinemark, where I think by the end of this year, it could retrace somewhere between this supply zone, which is $33 and $36. That's kind of what I'm thinking. If I can have a trade here from 21 to $33 in 12 months, for me, that's a good trade. And A lot of times when we get a good entry, we get these price targets hit long before 12 months, but it's really going to depend on how the box office does this. Thank you guys for tuning in this morning. Good luck on your trades. If you're in the Discord, I will see you there.
A rectangle down by the dip, gotta hold our ground. We've been waiting for so long. Hedges rain will soon be gone. A green candle up, a red candle down by the dip, gotta hold our ground. Hedges gains are dead and gone. Fuck the shorts, we're going long. If you doubt it, sit and stare. If you love it, buy a share. A green candle up, a red candle down by the dip, gotta hold our ground. We've been waiting for so long. Hedges rain will soon be gone. A green candle up, a red candle down by the dip, gotta hold our ground. Hedges gains are dead and gone. Fuck the shorts, we're going long. If you doubt it, sit and stare. If you love it, buy a share. A green candle up, a red candle down by the dip, gotta hold our ground. We've been waiting for so long. Hedges rain will soon be gone. A green candle up, a red candle down by the dip, gotta hold our ground. Hedges gains are dead and gone. Fuck the shorts, we're going long. If you doubt it, sit and stare. If you love it, buy a share. Green candle up and red candle down by the dip, gotta hold our ground. Hedges gains are dead and gone. King stops rising, going strong. If you doubt it, sit and stare. If you love it, show you care. A green candle up, a red candle down by the dip, gotta hold our ground. We've been waiting for so long. Hedges rain will soon be gone. A green candle up, a red candle down by the dip, gotta hold our ground. Hedges gains are dead and gone. Fuck the shorts, we're going long. A green candle up, a red candle down by the dip, gotta hold our ground.